All right, what's going on? So welcome back to the YouTube. In this video here, I'm going to explain to you guys our housing short thesis in U.S. home builder stocks and some ancillary companies, mortgage origination companies that we put on in July and August of 2023. Business Insider covered this in depth. We basically explained to them why our thesis for short housing was put on, and essentially why, if you guys had followed this article or what I was talking about prior videos, this was the largest short position we had on in our hedge fund and our personal accounts in the last 3 years. So I'm going to break it down in this video. I'm also going to break down why the thesis for U.S. home builders to be shorted is likely going to extend into 2024. We now believe in Q2, Q3, and Q4 of 2024, the likelihood of retail housing, physical houses, not actual home builders, is likely to drop 15 to 20% plus, okay? Whether you agree or don't agree, I'm going to explain to you in this video and break down a few of those ideas. Let's just get into it, okay? So the first thing I want to talk about is this, in this particular idea, is who we are and why we started to short this. If you understand our approach to investing in markets, it'll give you a better perspective of why this idea even existed in the first place. So when I say we're a small hedge fund. There's myself, an analyst, and a COO. We run it out of Phoenix and in San Juan. We also write this research report. We publish this every week. It's called the LongVol report. So we're not value investors. We're not short sellers. We're not dividend investors. The way we look at the market is an opportunistic approach. We use a macro approach to looking at markets. So whatever central banks are saying, whatever they're doing, we follow that. Whatever business cycles there are, we follow that. If there's stock spinoffs, we look at that. If there's stock buybacks, we look at that. We look at catalysts across sectors across the world, try to understand that catalyst. Once we understand the catalyst, we then begin our due diligence to buy or short in that particular sector. So in this particular situation, because housing is affected by central bank policy, i.e. interest rates, we begin to look there. So that is the start of this entire short thesis. Central banks are increasing interest rates, pulling money out of the system. So back in July of this year, we put this into the report. We began tracking one of the ETFs. This is a proxy for real estate in the US. If you're not familiar with it, the ticker symbol is NAIL, it's NAIL. This has home builders and home builder suppliers. This is July of last year. This is one of the names we shorted. It's down over 60% since July and August, okay? This is already showing you that home sales on the new builds are already slowing down. Also, suppliers are slowing down as well. I'm going to show you why the data we looked at basically led to us shorting this name and other names as well, okay? So that's the start of this. Let's move on to the second part of why we did this on some other data points. The first data point is this. We believe, and again, it's been proven to be true as I get into this, that the US consumer is out of money. They're constrained, they're tapped, spending is starting to be constrained. It's obviously an issue. When you have a rising interest rate environment, there's a cause and effect scenario. It doesn't only just affect corporations, it obviously affects the consumer as well. Tack on inflation, it causes another issue as well, okay? So what we thought we were going to see begin to happen, we actually think it's going to get worse, because eventually we think it's going to get so bad that the last kind of kitty or savings account people have is in their homes. We believe they're going to have to either use HELOCs or tap their home line equities to survive because things are getting too expensive and they're out of money, okay? So here's some of the names we shorted. It was a pretty big short position. We didn't talk about all of them, but these are some of the main names. So KB Homes, DR Horton, a lot of these names are well off the highs. We basically shorted a basket of these names as well as some loan origination companies as well, okay? I want to start with this here before I get to the data points to support our thesis, because this is an important line I think people should pay attention to. So I'm not throwing shade against them, but this is typical of Wall Street stuff. Bustamante calls for home prices is an outlier in terms of where Wall Street economists see the housing market headed, okay? I was there in 08, 09. I saw it all happen. It basically cost me a job on Wall Street coming out of college to get onto it. They blew it up then. Wall Street economists are academics. In my opinion, they have no idea how the real world works, okay? They see it where they see it. They don't understand it at all. They're always late to the data, okay? Every single time. They're wrong in 08, 09. They're wrong again this time. And again, I understand why you said it. I'm fine being an outlier. Contrarians make money in markets. This is a very contrarian bet, but so far we've been proven to be right. So what are the indicators we looked at? Number one is this. When we understand that interest rates are rising, where's the cause and effect? Credit card. We want to see what credit card debt is saying. So we looked at that, which I'm going to pull up. We looked at auto loans, which are starting to become delinquent. We looked at savings and checking accounts, and we looked at student loans. Okay, so I'm going to pull up these charts here. This is some of the data we got into back in August. I posted this on the website, and we talked about this here. Okay, before any of this happened, back in June and July, before the student loans became payable again, we started to look at that. You already had a constrained consumer, and I'm going to show you this here in this data points that you can pull up as well. These are credit cards. In 2020, they dropped, we believe, because of PPP, all the money put into the system. Everybody became somewhat wealthy. E-com businesses, everybody became gurus. Everybody seems to have a lot of money. As soon as that money was spent, credit card debt hit $1 trillion. Okay. Now that's okay. We live in a society in the West, the society that spends, we consume. Without debt, the society doesn't exist. Every new year, there's a new car. Every 12 months, there's a new iPhone that comes out. We spend, we upgrade. We spend, we upgrade until there's no money left to spend. And that's what we believe is happening right now with the US consumer. We believe that they're close to out of money and living essentially not paycheck to paycheck, but pretty close. Okay. The second thing is this: auto loans. Auto loans hit $1.6 trillion. It's the highest payment on average nationwide ever. Worse than that, just like credit card debt is, delinquencies are starting to rise. It's one thing to take out credit and pay it down. It's another thing to take out credit to live on because you're out of money and not pay it down. You're not seeing that happen here. Okay. It's just constantly rising. Now, the third thing is this is student loans. Student loans take out a lot of discretionary spending from the market. If you have student loans that come back online that take out $300, $400, $1,000, $2,000 away from your potential mortgage payment, that causes an issue for buyers. I don't think people that are biased in this particular position, we're not. We put our money where our mouth is by shorting a large amount of money in these particular names. I think people see it from a certain perspective. When we look at the markets, whether it was housing short, Carvana short, or Charles Schwab earlier this year, we look at it from a very objective perspective to try to understand where are we wrong. Okay. In this particular instance, having talked to a lot of people, unfortunately, I don't think we're wrong this time. Okay. The fourth point is this: is banking balances. This is Liz Ann Saunders from Charles Schwab. In fact, for those of you who don't know, this is where I started my career at the age of 20 at Charles Schwab in Phoenix. Okay. So this is a data point from Bank of America. These are people with 50 to 250 income groups. Okay. So people making 50,000 to 250, these are checking and savings accounts. This is 2019. This is 2021. Okay. Everybody was crushing it because of the money we put into the system. Small businesses crushing it. PPP money put into the system, however it was used, even nefariously, everybody had money to spend. Once that money was gone, what's next to be tapped? Checking and savings. It's that simple. Okay. When you're out of money here, you go here to get it. It's time immemorial how this stuff works. This was August 17. They were basically dropping at the slowest pace. You weren't seeing them rise again because the consumer is out of money. Now, this data only got worse. I explained it to Business Insider in the article. He went and looked at a particular piece from the Federal Reserve. Here's what the Federal Reserve said. According to them, as of last month, September, the excess savings from the pandemic was essentially basically going to dry up. Okay. Savings built up by American households during the pandemic are all but gone, says the San Francisco Fed. The data suggests from a record of 2.1 trillion in 2021 is now 190 billion. Okay. We can't help ourselves in the West, especially the United States, from spending money. Everybody's got to spend money on the new next big greatest thing, which eventually causes issues in the marketplace. Okay. So that was our short thesis on home builders. It's worked extremely well. If you look at some of these names, they're well off the high. It's not even debatable that they sold off extremely well. Okay. Now here's one of the other data points as well. Credit card debt is now delinquent 2.8% from 2021. Auto loans are starting to become delinquent as well. You can look at the data there and start to see that. Again, it would be one thing if auto loans and debt was rising and they were getting paid off, but they're not. Okay. We believe the consumer is constrained. We believe that leads into a lack of buyers in the market. Okay. And we think that's going to continue to 2024. So in short, that's our short thesis. The rest of it's on the website. I'm going to give you guys the final point in this video here. For better or worse, our short thesis changed. Originally, it was only basically tied towards home builders supply companies, and some mortgage companies as well. We think that's changed. We think in Q2, Q3, Q4 of 2024, because the consumer is constrained, they're going to have to tap their home equity. Whether that's through a HELOC, whether that's through selling their home to get the money out, we think you're going to see a massive supply of homes on the marketplace. Now, again, the opposing side is going to say this, and rightfully it's their opinion. They're going to say, good, we need supply in the market because we don't have enough houses to basically sell. Good luck trying to get people to buy those homes if unemployment starts to rise. The Fed is on a mission. They need unemployment to rise. If they get that number to 4, 5, 6%, there's a guy from literally The Big Short, the movie. If you guys remember the movie, literally The Big Short, where they shorted housing in 2009. This is him, one of the guys, Porter Stansberry. Last time I asked him a simple question. I basically go, Porter, any thoughts on residential real estate? He goes, housing shortage will keep home builders going until unemployment spikes. So unemployment 10% by this time next year. Now, again, he's just like anybody else with an opinion. I don't think it's getting to 10%, regardless. If it gets to 6 or 7, you have a problem in the first place. But I think people are still forgetting the US consumer is tapped. Spending is going to continue to slow. If they're out of money, we believe, simply put, they're going to go to their house to access that capital. So that's our short thesis on home builders and housing. If you guys have questions, head to the website. We're going to be hosting a webinar probably, I haven't announced it yet, more than likely at the end of November or early December. We're going to be talking about some of the new housing short ideas and other ideas that are going to affect us from a macro perspective in 2024. If you go to the bottom of the website, go to webinars, you'll see the new webinar we're going to list. We'll be talking about it then. So that's our short thesis. I'm going to link the Business Insider Approach or article below. You can also read the other research we put on the website if you go to the longvol.com. That's it for me. Thanks for watching. I'll see you guys in the next video.